This is Michael Can speaking, and these are weekly comments for the week of August the 19th, 2013. The end of summer marks the new year for families with school-aged children, and for stock market veterans, it announces the beginning of the historically most volatile months. This is a time to take stock of the big picture and evaluate how we are positioned for our current outlook. So first, let's consider 5 items. 1. The S&P 500 has risen from 1100 to 1700, or more than 50%, since October 2011, with virtually no pullbacks and certainly not a correction. A 10% correction would be healthy at some point in time and have markets retraced to just over 1500. 2. Kathleen and I are convinced that interest rates are headed higher. After 32 years of interest rates falling, we expect rates to rise slowly back towards more historically normal levels. In recent months, the U.S. 10-year Treasuries have risen to 2.8% from 1.7%, and some bond investments may have considerably more risk than investors can appreciate. 3. It would appear that the Fed is prepared to begin tapering their unprecedented monetary stimulus. One must consider that this may be the end of cheap money that has helped to push global stock markets higher. 4. According to recent reports, Ben Bernanke will relinquish his position as the head of the FOMC in January. In our opinion, Mr. Bernanke has shielded the global economy from a more serious economic event, but how will his successors act? And what if the new FOMC leaders try to distance themselves from Ben Bernanke's programs, which were not always universally embraced? And fifth, investor behavior in recent weeks has been erratic. In part, that has been influenced by the Fed's comments about tapering, but perhaps the margin debt levels in the U.S. market are indicative of a level of enthusiasm in U.S. stock markets and the need for debtors to reduce their leverage. As seen in the attached diagram, this level of debt has been indicative of a stretched market. So in a nutshell, with seasonality and what appears to be an inflection point for interest rates and Fed policy, it is time to be vigilant in our portfolios. Even as we believe interest rates are headed higher, we temper our expectations of just how much higher rates can rise, as governments around the world are the primary debtors, and with sluggish global economies, they cannot afford significantly higher interest costs. This is a period of change. We still see equity markets as reasonably priced and attractive relative to debt markets, but we need to be careful and assure portfolios can withstand potential changes that may result from the inflection points that seem to be forming. As such, we continue to like authentic hedge strategies, short bond maturities, and floating rate bonds, income paying equities, and finally, insurance companies, which tend to be trading at below book value, have decent dividend yields, and tend to benefit from higher interest rates. That's it for this week. As always, thank you for listening, and we wish you and your family well.